Everybody, just let me share my screen here. Okay, so this report is on the Tax Cuts and Jobs Act and looking back how the Tax Cuts and Jobs Act has changed the tax landscape and how it's changed repatriation into the United States. If you remember, one of the things that the Tax Cuts and Jobs Act was intended to solve was the issue of trapped cash, money that U.S. corporations had held outside of the United States that couldn't be brought into the U.S. because it would be taxed here at 35%. So for example, Apple had $240 billion offshore. Microsoft had $122 billion offshore. Estimates of the total trapped cash outside the United States in 2017 were between $1.5 and $4 trillion. The repatriation tax in the Tax Cuts and Jobs Act didn't force companies to bring their cash back to the U.S. It just taxed it with the expectation that as soon as it was taxed, companies would choose to bring it back. And then, just take a look at what happened. The total amount of cash sitting offshore has just plummeted. Apple's offshore cash is only $13 billion today, and other companies with hundreds of billions of dollars offshore brought much of it back as well. The amount sitting offshore for many companies is so small today that it's not even material enough to continue mentioning in their SEC filings. And obviously the TCJA got a lot of flack for cutting the corporate tax rate from 35% to 21%, but as this chart shows, the amount of corporate tax revenue coming into Treasury has increased since 2017, and that's even if you factor in inflation. So how can that be? Well, what I described in the note is that the Tax Cuts and Jobs Act actually did what tax policy nabobs always suggest that these kinds of bills need to do to cut statutory tax rates. It broadened the corporate tax base. One main facet of this expansion was the global intangible low-taxed income tax. It's also called the GILTI. It's intended to be, as it describes, a tax on intangibles, but that's not how it's described in the Tax Cuts and Jobs Act. It's actually described as essentially a catch-all tax, and it essentially summarizes the international tax rules that already exist. And it says that this tax, the GILTI, applies to what's not already taxed, and it's actually doing that. In the latest data from the IRS, which is from 2023, U.S. corporations declared $3.7 trillion in GILTI. That's income that was flying under the radar before the TCJA was adopted. And another goal of the TCJA was to attract non-U.S. investment. And that's also increased as well, although I should point out that when you factor in inflation, there's a substantial dip in 2022. Interestingly, the origin of the foreign investment has also changed. In 2017, it was largely coming from the UK, but by 2023, the UK had taken a backseat to Japan, Canada, and Germany. And then moving on to the second part of my report, I talk about what's changed in tax world, how the territorial tax system and the GILTI have made a lot of the tax planning that existed before the TCJA a whole lot less effective. And that's why if and when the Tax Cuts and Jobs Act fully phases out at the end of this year and in 2026, corporations could be left in a worse situation than they would have been had the TCJA never been passed in the first place. Because as I just said, that the tax base has broadened. So if tax rates go up, it applies, those larger tax rates apply to a lot more income than before the TCJA had passed. And the simplest way to get cash into the U.S. is to make a dividend. And now that we have a territorial tax system, we have what's called a participation exemption. So when the cash comes in, there's a tax, but then there's a full credit for that tax. What that means is that the foreign tax credit that you would have gotten under the old system when you bring your cash in no longer exists. Why? Because there's no inbound tax anymore. So yeah, you get a full credit, but you don't get credit for your foreign taxes. And that's especially true of dividend withholding taxes that were credited under the old system. Also, as I said, the tax base has broadened. So the vast majority of the cash coming to the United States has already been taxed in the U.S. It's phantom income. It was taxed in the U.S. long before it was brought into the U.S. And then there's the loan. You can lend money from an affiliate abroad into the U.S., and if that money is never paid back because the loan is continually rolled over, for example, it's effectively a dividend. So the U.S. treats it. So the U.S. actually treats it as a dividend to the extent of the earnings of the foreign lender. Interestingly, this provision still exists despite our new tax system. So there's a constructed dividend into the United States, but that dividend is taxed because the participation exemption doesn't apply to these so-called 956 loans. Additionally, these rules apply to guarantees as well. So if a U.S. entity gets a loan from a U.S. bank and that loan is guaranteed by the foreign affiliate, that too results in a constructed dividend. And then reorganizations. One of the most popular ways to bring cash back into the U.S. Prior to the TCJA was via M&A. And one of the more popular strategies was the so-called Killer B. It gave rise to a dividend into the United States to which no or very little U.S. tax applied. But now that we have this territorial tax system, the cash that would be brought back using the Killer B has already been taxed. And once it comes back, there's no longer an inbound U.S. tax that applies. So these kinds of reorganizations are now a whole lot of bother for essentially no benefit. And then there's IP planning. At one time, corporations used to form IP partnerships in which the U.S. would contribute IP and the foreign entity would contribute cash. And over time, the ownership of the IP would transfer from the U.S. entity to the foreign entity. And once the ownership changed, the U.S. would have to pay the foreign entity for the use of the IP in the form of licensing. But now income from IP is clearly GILTI, and moreover, we have the foreign-derived intangible income preferential tax rate, which incentivizes companies to bring back their IP. And the last part of the note I talk about is transfer pricing. The TCJA didn't deal with transfer pricing, but in the years after the adoption of the Tax Cuts and Jobs Act and the Inflation Reduction Act, which allocated a higher budget to the IRS, transfer pricing enforcement has gone up substantially. And we've heard that advanced pricing agreements, which give companies comfort that their transfer pricing is going to be acceptable to the IRS, are on the decline. So the IRS is attacking more transfer pricing planning and offering less protection. So my report essentially shows that the Tax Cuts and Jobs Act has actually achieved at least some of the goals that it had been intended to achieve. And it's by no means a perfect tax reform effort, but it closed loopholes and broadened the corporate tax base, and it resulted in domestic repatriation and increased foreign investment. So that also means that losing the benefits of the TCJA would be a huge tax increase for companies. So thank you once again for listening, and please reach out to me with any questions or comments.